more evidence that ESG is going to reduce your returns rather than increase it. But when I make this case to ESG advocates, their response, even if they agree with me, is, well, that's okay because we're making the world a better place. Are you? When companies adopt ESG and investors invest in good companies, are you going to make the... I'm going to argue that that is not true. That in fact, ESG makes people feel good, but in fact, it's not making the world a better place. And I'll close on a hopeful note. As human beings, we all are hardwired to be good. Right? We have all these temptations that lead us to bad, but we're all hardwired. We want to do good. So for some of you, you might say, look, I want something that helps me be a good person. I'm going to give you a roadmap to do it. You're not going to like it because through the history of humanity, think about it. Being good has always been the more difficult path, right? I mean, every religion, you don't need religions. If we were naturally good as human beings, we would not need religion. The nature of being good is you got to give up something. Which means that if you want to be good, you got to be willing to make some sacrifices. And if you don't want to make sacrifices, don't lecture me on how I should be good. I'm sick and tired of the sanctimony in this space where people wag their fingers and say, you need to be good, you need to save the planet while they're flying 5,000 miles to a conference and buying carbon offsets to cover their costs. Stop lecturing me. So I'm going to start with the first part of this, which is, what exactly is ESG? Now, when I started this process in 2019, I was told that ESG measured goodness. And already we're in a dangerous place, right? If I went around this room and asked each of you to describe what goodness is to you, what does a good person do? I'll wager, there are 26 people in the audience, I'll wager I'll get 26 different definitions of goodness. Think of why. It reflects your upbringing, your culture, your religion, the part of the world you grew up in. We each have our definitions of goodness, what we look for in a good person. So let me ask you a question. How does Sustainalytics or S&P come up with a measure of goodness that captures all our different definitions? You're going to see this show up in a very simple statistic I'm going to show you on the scores that different ESG services give to the same company. Now, if you ask ESG advocates, their response is, hey, this too shall pass. We're just learning how to measure ESG. That's a bunch of bunk. This cannot pass. It's not like there can be a consensus on goodness, right? So how the heck is Sustainalytics and S&P going to get on the same page if we each have our own definitions of goodness? So let's build on that thing. If you think about what bedevils ESG scores, first, it is fuzzy. You're trying to measure qualitative things. I'll give you one example. One of the things that services are trying to measure is how diverse your workforce is. Already you can see you're stepping onto quicksand, right? How are you going to measure diversity? The percentage of females on my staff, is that going to be a measure of diversity? The percentage of minorities on my staff? It's fuzzy. Your definition of what diversity is and my definition of diversity are going to diverge. Second, as I noted, it is person-specific. Each of you, if you came up with the ESG score, are going to weigh different things. But the reality is people are measuring it, right? S&P measures it, Sustainalytics, and companies are actually playing games trying to push up their score. So here's a very simple statistic on why there will never be divergence. This is from, it's an informal survey. I'm not going to generalize from this. But this asks different people, what is the quality you look for in goodness in a good company? And they ask young people, older people, and guess what? Depending on the age of the person, people value different things. Young people seem to look at global warming a lot more than older people did. So are we measuring ESG to 25-year-olds, 55-year-olds? It adds to the point that ESG as a score is going to shift depending on which group you're measuring it for. And there will never be a consensus because there cannot be a consensus. In fact, there's evidence out there on how ESG shifts. The first is whenever you get a macro development of some sort, you're going to get ESG shifts. I'll give you an example. Earlier this year, I'm sure you're all aware of the Russia-Ukraine conflict, right? And it actually turned ESG services on their head because leading into March of 2022, you know what ESG services were telling us, right? Fossil fuel companies are evil. Weapons manufacturers are evil. And then Russia invades Ukraine. And all of a sudden, we need oil around the world, and Russian oil has been cut off. Magically, services reinvented ESG, saying it's okay to be a fossil fuel company now because we need oil. Okay, that's very convenient. It's okay to be a weapons manufacturer if you sell to the right side. In fact, I saw a news story last week that I should say for posterity. Philip Morris. So as with each part of the story, I wanted to think about if you're an ESG service, what kind of score would you give it? Philip Morris, you know what Philip Morris produces, right? Tobacco. Good company or bad company? Or so if I just stop tobacco, you're saying, terrible, you're an awful company. You produce a product that causes cancer. Okay, let me finish, go on with the story. Philip Morris is going to give away 500,000 packets of cigarettes for free. You're saying, this is awful. You're taking a cancer-causing product. You're probably giving it to teenagers to addict them. But let me finish the story. You know who they gave the 500,000 packs of cigarettes to? Anybody read that story? They gave it to Ukrainian soldiers on the front lines. God, are you confused now? You're saying, on the one hand, it's a tobacco company. On the other hand, it's giving away, but they're giving it to the right people. These poor soldiers, they need the cigarettes. You're hoisted on your own petard. You better live there. And as the politics shift, you're going to see ESG services shift with it. In 2020, in the US, when you had Black Lives Matter kind of come to the surface, you know what ESG services did? They said, you know what, we're going to bring in that factor into ESG scores. Now the politics have shifted, and all of a sudden you see that getting downplayed. But riding over all of this, and this is, I think, what's contaminated the ESG movement, is the way you measure ESG is going to be driven by the people who are making money of ESG. Think about who's making money on ESG. You got consultants. McKinsey has an ESG arm. I don't even know what's happened to McKinsey because I've read some of their articles in the last few, but I know exactly what's driving it. They see an opportunity to make money. Investment fund management. So your ESG score is going to reflect what they find useful in their sales pitches. So here's a statistic that I want you to think about when you think about ESG scores. There are multiple studies that show this, but I'll point to a few. What these studies look at is the correlation across ESG services in scores. In other words, you got, I think, 6 major services that measure ESG scores for companies. They take the same company and say, hey, where does this company fall? So 2 years ago, for instance, one of the services had Facebook as one of its best companies, or if you want to prefer in the frame of good and bad, the goodest companies. And another service at the same time had it as one of its worst companies. You see, how can that be? It depends on what the service weights in. If you weight in fossil fuels and climate change, any technology company is going to start off with an incredible advantage, right? Because if you're a manufacturing company, I don't care how well you've been run, you're going to create more of a carbon footprint than if you're a software company. So what these studies consistently find is the correlation across ESG scores across services is low. If you look at bond ratings, you don't get that phenomenon, right? S&P and Moody's and Fitch, when they rate companies, you might have disagreements, but the correlation is closer to 0.95 because they're measuring something that they agree on, that they know what they're measuring. ESG, you don't have that end game. But here are some more troubling statistics. This is true even if you take high-profile companies. Here, for instance, there are 6 high-profile companies, Facebook, JP Morgan, and you don't even get disagreement on high-profile companies, not even small companies. These are on big companies. But why you should be suspicious of these scores? There are a couple of interesting statistics that people have computed by looking at ESG scores. Do you know that ESG scores for big companies are consistently higher than ESG scores for small companies? Well, you could take that and say, well, that must mean good, big companies are good and bad, small companies are bad. I don't think so. You know what that tells me? To get a high ESG score from a service, what do you need to do? You need to fit in check boxes. You need to do the things they tell you are important. And it goes to dozens and dozens of items. If you're a big company with lots of resources, you can check those boxes. You can get a higher score. What this tells me is ESG scoring has become a game, and big companies, money-making companies, are much more capable of playing that game than small companies end up with higher scores. Do you also know that ESG scores go up as you disclose more? It doesn't even matter what you disclose. The more you disclose, the higher your score. What does that tell you? It tells you that if you have disclosure diarrhea, where you just disclose everything, you're going to get a higher score. So the next time you see a high ESG score for a company, it might mean that your company is a good company, or it might just mean that your company is a big company, or a company that discloses hundreds of pages of nothing but gets away with a higher score. ESG scoring has become a game. And when something becomes a game, people learn how to play it. And as they learn how to play it, they're going to score higher scores, but not necessarily be doing the things that you want them to do. So I made this point in a 2020 post on ESG on my blog. And I heard from the head of one of the major ESG measurement services. I won't name the service because I won't embarrass that person. And here's what he said. He said, all of your critiques of ESG being a measure of goodness are true, but we don't measure goodness. I said, that's news to me because I thought that was the whole point of having an ESG score. He said, no. ESG is a measure of risk. I said, really? One of the things you got to learn about people in the ESG space is they just make stuff up. They make stuff up out of thin air. I said, what do you mean? He said, it's measuring risk. So I said, what kind of risk? He said, what do you mean, what kind of risk? Is it measuring equity risk or risk to lenders to a company? He said, I don't know. And I said, you do know that there are services that measure the risk to lenders, and maybe if there's a risk there, they should be showing that there rather than an ESG score. He said, well, that must be equity risk. He's making up stuff as we're going along in this conversation. I said, okay, let's see if that's true. If ESG is measuring equity risk, it should show up in some proxy for equity risk, market volatility, stock price volatility, earnings volatility. So I took ESG scores that these services had turned out and correlated with measures of equity risk. And guess what? I found no correlation. In fact, the correlation was positive. Companies with higher ESG scores were riskier, not safer. I'll be quite honest, I have no idea what ESG services are actually measuring. But I'll go further. I don't think the ESG services have any idea of what they're measuring. This is like Jell-O. It just molds to whatever you put it in. It's become almost meaningless. So ESG cannot be measured. You're building an entire edifice on something that cannot be measured. Let's talk about ESG and value. When I teach my valuation class, I start the class with what I call the IT proposition. I said, look, if you want to tell me something is going to increase value or change value, you got to show me where it's going to show up. And let me cut to the chase. The value of a company comes from 5 inputs. 5. I mean, you can have 500 inputs in your spreadsheet, but ultimately 5 inputs drive the value. The first is revenue growth. Higher growth companies are usually better than lower growth companies, usually because there's a catch. Second is profitability, capture the operating margin. Third is how efficiently you deliver growth. Revenue growth, operating margin, and investment efficiency. That drives your cash flows. You discount them back at a risk-adjusted discount rate, a cost of capital that reflects your cost of raising money from equity and debt. And hanging over all of this is the worry that you might not make it, failure risk. Revenue growth, operating margin, some measure of investment efficiency, sales to capital, return on capital, cost of capital, and failure risk. You tell me a story about something increasing value, I'm going to look for, hey, where in those inputs would I expect it to show up? So as part of the exercise of understanding ESG, I went back and read almost every ESG piece I could get my hand on. And I have to be quite honest. The quality of research in ESG is abysmally bad. It's almost like these people have never taken a statistics class. That's one possibility. Or two, they're so incredibly biased. In other words, they want a result, and all of this research is designed to deliver that result rather than ask the question, is this true? So I broke down the research into what it told me about revenue growth margin. So I said, let's see if there is any evidence that ESG is good for value by looking at what it tells us about growth and margins and reinvestment and risk. On revenue growth, I found zero evidence that being good lets you grow faster. In fact, I found a lot of evidence that being good constrains your growth rate. And here's why. Whenever I ask people to name a company that is where ESG has paid off, being good has paid off, one of the companies that comes up consistently is this company called Patagonia. You heard of Patagonia? You know what Patagonia does, right? It makes $500 jackets for 25-year-olds who are feeling guilty about the planet. But it has this aura. We're a good company. We sell only to good people. Okay. Whenever people bring up Patagonia, I ask them a question. You know how much revenue Patagonia had in the most recent fiscal year? Most of the people who use Patagonia as an example don't know the answer to that question, to which my response is, stop using a company as an example if you don't know what they've delivered. It's about $900 million. That's the revenues at Patagonia. So they're good, but the revenues are $900 million. You know what Nike's revenues were last year? About $35 billion. If you're a company with $900 million in revenues, you can afford to have a niche market and talk about goodness and say, if you're a bad person, don't buy our jackets. Nike can't afford to do that. If you want to be good, you got to accept the fact that you might go after a niche market and settle with it. Isn't it? There's no evidence that being good increases growth. In fact, there's lots of evidence that it will actually constrain your growth rate. I said, maybe being good makes you more profitable. And here the research actually looks supportive of ESG. At least in the broad sense, it looks like companies that score higher on ESG have higher profit margins and higher returns. This is good, right? And then people look at that correlation and say, that must mean being good makes you more profitable. That's absurd, and here's why. You've heard of Whole Foods. Whole Foods is this high-end grocery store in the US. It's now owned by Amazon. If I did a regression of people's wealth levels and how much money they spend at Whole Foods, that the correlation is very high. So if I ran a regression of what's your wealth level regressed against how much money you spend on Whole Foods, the regression delivers the result of, hey, they're very highly correlated with each other. Now, if I then drew the conclusion that shopping at Whole Foods makes you more wealthy, you'd slap me down, right? You think that's stupid. Because the causation runs the other way. You shop at Whole Foods because you're wealthy. You don't become wealthy by shopping at Whole Foods. You think, what's this got to do with ESG and profitability? People run these regressions of profitability against ESG. And they say, look, higher ESG scores deliver higher profits. What if I turn the regression equation around and told you that being more profitable allows you to play the games that allow you to deliver a higher ESG score? Prove me wrong. There's actually a way to test whether ESG increases value. You know how you do it? You take companies where ESG scores have increased and then look at profitability in the subsequent period to see if it goes up. Nobody does those studies. You know why? Because there's no evidence to back up the fact that increasing ESG scores delivers higher profits. Just made up. There's zero evidence on ESG and efficiency. I looked in every paper. Nobody even asked the question, are you investing more efficiently? And I can't think of a reason why you would. I've seen people tell me that, hey, companies which have higher ESG scores have lower cost of equity. Stop making up stuff. These are people who wouldn't even know a cost of equity or cost of capital if it jumped out and kicked them in the face. And they make the contention that being good gives you, at the start of every year, I compute the cost of equity and cost of capital for every publicly traded company on the face of the earth. 46,000 companies have their cost of capital. I have ESG scores for about 2,000 of those because those are the only 2,000 of scores. So when I started hearing this nonsense about having higher ESG scores gives you a lower cost of equity, I said, okay, it's an empirical question. Let me see if it's true. And I can tell you conclusively that it's not true. In fact, if you look at the correlation between ESG scores and cost of capital, having higher ESG scores gives you higher cost of capital. But unlike these people who do this shoddy research, I'm not going to claim it's higher ESG scores that cause higher cost of capital. I'm going to argue that it's spurious correlation. You know what spurious correlation is? There's something else driving both. And you know what that something else is? Over the last 12 years, when you look at ESG portfolios, high ESG scores, they've been disproportionately technology companies. Why? Because it's been a very heavily driven, fossil fuel driven view of ESG, right? What's your carbon footprint? You have a big footprint, you're a bad company. And Google will obviously fare much better than Ford when you make that comparison. Technology companies have high ESG scores. Technology companies have high margins. You run a regression of ESG scores against margins. It looks like they're correlated, but the core comes from that focus on technology companies. There's one small piece of evidence on ESG that works in ESG's favor, at least on this dimension. I told you there is no evidence that good companies have lower cost of capital. But there's a subset of companies that ESG has branded as bad companies, where there's some evidence that they have higher costs of capital. You know what that subset is, right? Fossil fuel companies. ESG has managed, at least with fossil fuel companies in the US and Europe, to get enough investors out of the game. I mean, I teach at a university. My endowment fund, NYU's endowment fund 2 years ago, it doesn't have that much money. It's not like Yale or Harvard, decided it would not invest in fossil fuel stocks. Been able to put, you're saying, so what? If enough investors actually take fossil fuel stocks off the list of companies that they can invest in, the cost of equity of fossil fuel companies are going to increase because now you have a smaller demand for those stocks. That's the only segment of the market where there's any evidence of a link, but it's very specifically on fossil fuel stocks. And as I'm going to argue in a couple of minutes, that actually works against ESG on its next big sales pitch to investors. But that's the only piece of evidence. I've also heard ESG advocates argue that you should try to get a high ESG score because it'll reduce catastrophic risk, failure risk. And there's an element of truth to this, right? When you look at companies that get into big trouble, BP after the Alaska oil spill, Vale after it had a dam that burst and thousands of people died. Maybe there's an argument that being good would prevent that from happening. I would love to see evidence of a company that you could have avoided before the catastrophe because the service gave it a low ESG score. In every single case, when people claim, hey, if you'd done this, you'd have avoided the problem, it seems to be after the fact. Facebook had a really high ESG score in 2017 when the privacy scandal blew up. It wouldn't have helped me after the fact. Put simply, there is no evidence that ESG is good for companies. And I can argue that there's just as much or more evidence that ESG will reduce value for companies as it is to increase value, because it increases their costs, reduces their margins. Now, it's of course true that some companies can use ESG as a marketing tactic. And let's face it, 95% of ESG is companies framing things so they can sell more. And sometimes I think they underestimate how much cynicism there is out there. You've heard of Unilever, right? Consumer product company, been around 100 years. For the last 5 years, Unilever's spent a lot of money trying to become a good company. I'm sure there are consultants coming and say you can improve your ESG score. What does Unilever sell? A bunch of crappy stuff that's not good for your health. One of the biggest brand names is Hellmann's mayonnaise. Have you ever had this mayonnaise? It'll kill you while you're eating it, right? Because it's just, it's egg yolk and it's just bad for you. But they ran this entire campaign to convince, based on their ESG consultants, I guess, to show the world that Hellmann's was actually good for the world. It's amazing that what marketing people can do. But this is nonsense. Don't tell me that you're a good company because you make mayonnaise. There is no way on God's good earth that Coca-Cola should score higher in ESG if you define ESG as goodness. I mean, how can a product that's filled with sugar and essentially probably is more responsible for obesity and bad health than any other product in the face of, but I'll tell you, if you have enough ESG consultants, they'll reframe it for you. So is ESG good for value? Not that I can see. You're saying, but I'm an investor. I don't care whether ESG is good for companies. I think I can make money in ESG. That's what you've been told, right? For the last 14 years, the sales pitch is if you invest in good companies, you'll make higher returns. And I'll give you the basis for the sales pitch. If you go back, and this has to be retroactive, because remember, in 2008, nobody was investing based on ESG. So most of these studies are retroactive, which means act as if you had ESG scores right from the beginning. What kind of returns would you have made on the stocks with high ESG scores? Guess what? At least in the US and much of Europe, there is evidence that investing in companies with high ESG scores retroactively would have earned higher returns than investing in the rest of the market. This is good, right? But I've already given away the reason why. What kinds of companies did I say ended up with high ESG scores using those conventional metrics? Or technology companies. That's amazing. So you made a lot of money investing in technology companies. You know what? I could have invested in companies which had the word software in their name. And over the last 10 years, I'd have made a lot of money. Why? Because it was a decade that belonged to technology companies. In fact, if you remove that sector bias, you're going to very quickly see the ESG returns go out of the window. And I'll tell you why. Or the next time you have an investment fund manager tell you investing in good companies earns a higher return, put them on the spot. Because remember, investing is not about the quality of the company. It's about what's being priced in. I'll give you a classic example. Would you rather invest in a good company or a bad company? Most people say, I'd rather invest in a good company. Well, that's not necessarily true, right? If everybody thinks that company is good, guess what happens? The price gets pushed up. You actually historically would have earned higher returns investing in bad companies rather than good companies, because investing is about buying at the right price. You see how this debate is to be reframed? Even if you believe that ESG is good for companies, I have a question. When you invest based on ESG, you got to convince me that that goodness is already not priced in. If green energy companies are already considered to be virtuous and investors are pushing up the price of these companies, you will make less money investing in green energy companies than in oil companies. And the evidence actually backs that up, because it shows that when you look at returns, you're actually looking at the effect of both whether ESG is good for value and the pricing, which makes it almost impossible to read a study that says, hey, high ESG funds make higher returns. What does that even mean? I'm not sure what you're actually capturing, because it's a pricing effect. So if you decontaminate these studies for the tech focus that you have in these studies, those excess returns you see for ESG, gone. ESG is not good for companies. It's not good for investors. And you see the same phenomenon in the ESG portion of the bond market. You've heard of green bonds, right? These are bonds where in companies which are in green energy, the returns there, which started high, have gone away. If there were any evidence of making money, it's gone. You're too late to the party. Virtue is now priced in. How the heck are you going to make money on it? So the implication for investing has to be that investing in goodness by itself is not good. You got to invest in goodness before the market prices it in. So if you think that 10 years from now, there's going to be something that investors are going to value in companies on virtue, you got to get ahead of the game. This is like everything else in investing. You can't just latch on to something markets already see. You got to see something coming down the pipe. And how the heck are you going to do it? This has nothing to do with finance, right? You got to be a judge of social morality and what people are going to find good 10 years from now. Good luck with that. Maybe you should spend all your time on TikTok videos, figuring out what young people like and what they don't like and get ahead of the game. But I don't see how you can build it into investing. Which brings me to the final defense that ESG people make, which is, hey, so what if it's not good for companies? So what if it's not good for investors? We're doing this to save the planet. How do you argue against this, right? It sounds like you're a bad person to push back. And that's what they hope you will do, is step away. Okay, then if it's good for the planet and good for humanity, I will step away. I'm not willing to do that. I'm going to push back and ask, are you sure that all of this stuff you're doing in the name of goodness is actually good for humanity? And I'm going to argue that it's not, because there's the law of unintended consequences you got to factor in. I don't know whether you've heard of this activist fund called Engine One. It's a fund that's very much driven by virtue. They took a share of, they bought a small stake in ExxonMobil, and they put pressure on ExxonMobil to divest itself of some of its fossil fuel reserves. And guess what? They succeeded. It's one of the huge wins in the ESG space. They keep talking, hey, look at what Engine One did at ExxonMobil. They got ExxonMobil to sell off some of its fossil fuel reserves. I said, congratulations. Who do they sell those reserves to? You ever ask that question? You stopped ExxonMobil from developing these reserves, but they went somewhere, right? Guess where they went? Over the last decade, private equity investors have invested more than $1 trillion in fossil fuel reserves. So guess what's happening? You managed to get ExxonMobil to sell its reserves. Congratulations. Guess who bought those reserves? Some of the least scrupulous people on the face of the earth. And guess what they're going to do with these reserves? They're going to develop them, and you'll have zero input in how they're developed. And you know how this shows up? After all of this virtue signaling in ESG. Last decade, ESG has taken off. Look, there are $11 trillion invested in ESG. You know how much of our energy came from fossil fuels in 2010? 82%. But they had 10 years of ESG after that, right? That must have made quite a dent. You know what percentage of our fossil fuel, of our energy came from fossil fuels in 2020, 10 years into ESG, and over all of this talk and lecturing? 81%. In other words, nothing's changed. So you're saying, what happened? This happened. You put pressure on US and European companies to not develop their fossil fuel reserves. But if you think for a moment Aramco is being intimidated because ESG people don't like it, you're on the wrong planet. You've just pushed the problems behind the curtain. You don't see it. And this is, I think, the problem is all these ESG advocates go home and they bathe in this, oh, look at how virtuous I am. I invest only in ESG funds. I put pressure on companies to get rid of their fossil fuels. Nothing's changing underneath. Because the reality is you're not solving the problem. What's the problem? Alternative energy cannot provide enough energy to cover the planet unless you let nuclear power plants open. But of course, until 2022, what was the ESG story in nuclear power? Terrible. You can cause all kinds of accidents. It's got to be wind and solar and hydro. The problem is, for wind, solar, and hydro, you're completely at the mercy of the planet. I live in San Diego. I can use solar power, but you live in Norway or you live in parts of the East Coast where the sun doesn't come out more than 20 days of the year. What the heck are you going to do depending entirely on solar power? This is the problem with ESG, is people want to sound good. They want to feel good. But doing good requires action that goes beyond putting pressure on ExxonMobil to sell its fossil fuel reserves. So I'm going to leave you with a final thought, because whenever I do this, and I do this for young people, at the end they say, but I want to do good. I want to change the world. Of course. That's human nature. We all want to change the world. First, dispense with the notion that until ESG came along, people didn't have any virtue. This is, I think, the hubris of ESG advocates. They think virtue was invented in 2008 when they came along. You think before you had professors with ESG in their titles, people didn't think about good or bad? Through the history of humanity, people have had to think about virtue. You've heard of the Anno Domini Fund. This was a fund started in the 1990s, well before ESG. And you know what it did? It invested based on Catholic principles. So if you were a religious Catholic and you wanted to make sure you're investing in companies that met Catholic principles, you could invest in the Anno Domini Fund. But even predating the Anno Domini Fund, you've had Islamic finance, right? For hundreds of years, essentially where religion directed, this is good, this is bad, don't go there. Who are these ESG people come in and say, well, we invented virtue in 2008. Here's what I see as the difference between the old world, pre-ESG world, and the post-ESG world. In the pre-ESG world, you know who was responsible for delivering virtue? It was you and I. It was a personal choice. We decided where to give our money. So if you got a lot of dividends on your stock and you felt guilty, you said, you know what, I'm going to make up for it by giving half my money to this charity because that's what I think goodness is. So in the pre-ESG world, individuals took that responsibility. In the post-ESG world, you know what ESG advocates want to happen? They want Jamie Dimon to decide what JP Morgan shareholders should be charitable with. They want Larry Fink at BlackRock to decide what goodness looks like. In other words, we're outsourcing our consciences to CEOs of companies and investment fund managers. And that's not going to end well. I like Jamie Dimon. I don't like Larry Fink, but I do like Jamie Dimon. But I don't want him deciding for me as a JP Morgan shareholder what good or bad is. Goodness is personal. We all have consciences. We all have to make decisions that we can live with. We have to sleep at night. So if your big deal is climate change, by all means, avoid fossil fuel stocks, but don't lecture people who invest in fossil fuel companies that they're bad people. It's none of your damn business. It's like walking around your neighborhood, telling your neighbors that they're being sinful. You know how popular you're going to be in your neighborhood if you keep doing that? So I think this notion that until ESG came along, nothing good happened has to be dispensed with. The question is, do you want to be in charge of what good looks to you, or do you want to turn it over to Sustainalytics? I don't know about you, but I have zero faith in Sustainalytics doing that decision for me. So you're saying, so why is ESG so widely used then? Because people are making a ton of money. I called it a gravy train, where people are collecting gravy. Like who? You got ESG services measuring ESG and selling those scores. Those services churn out scores to consultants who go to companies and say, do you want to improve your score? Here are the things you need to do. Just pay us 15 million. We'll tell you how to do them. The scores go to fund managers who use those scores to sell people ESG funds. And one of the reasons they love ESG funds is take a look at BlackRock, which I think is the most hypocritical player in this entire space. Remember the private equity investments in fossil fuel I showed you? Go back and take a look at that list. You know who's up on that list? BlackRock. It's talking out of both sides of its mouth. BlackRock has a fund called the Carbon Transitions Fund. Sounds good, right? Somebody at Wall Street Journal actually compared their Carbon Transitions Fund to just the core S&P ETF. 497 out of the 500 stocks were the same. The Carbon Transitions Fund was just the ETF with 3 stocks removed and a few weights changed, were almost exactly identical. You're saying, why are they wasting their time doing this then? Because they're claiming an expense ratio which is 5 times higher than the expense ratio they have in the regular funds. This is a scam. It's a scam that fund managers are running to collect your money and deliver pretty much the same portfolio they would have got without paying for the same. And corporate managers are going along. CEOs are going along for a different reason. You know, the old corporate finance model, the class I've taught tells, I tell my students, managers have to be accountable to shareholders, the traditional corporate finance model. Of course, the ESG model is the stakeholder model, which is a bunch of crap, because basically what they're saying is CEO should be responsible to everybody. You know what happens when you're responsible to everybody? You're responsible to no one. Because you use other interest groups as an excuse for why you didn't do well for each one. CEOs love ESG and stakeholder wealth maximization because it basically makes them kings of the castle. They can do whatever they want. So here's my advice to you. You want to be good? Look inward. Make your own judgments of what matters to you, what goodness is. If you run your own business, live it out, right? So if you believe that poverty is the fundamental problem we deal with as humanity, you run a business, take half your profits and give it to the poor. Leave your company to a charity rather than to your kids. If you're an investor and you care, make sure that you avoid stocks that are bad companies, invest in good companies. And as a consumer, you believe climate change is the fundamental problem. Stop driving that SUV. In fact, stop driving as much. Stop taking long trips. Now, part of you is saying, but I really like long trips. I really like my SUV. I like to make money on ExxonMobil. Guess what? Being good requires sacrifice. It requires giving up something. When somebody tells you you can be good and be better off at the same time, they are lying. They are lying. They're either fools or frauds. In fact, I'll close with a statement about this, which is when I look at the ESG space and I look at all these people in this space, I put them into one of 2 groups. You have a lot of useful idiots. Useful idiots in the sense they think they're doing the right thing, saving the world. They're not, but that's it. And you're feckless knaves. Feckless knaves basically are taking advantage of the useful idiots to make money. You have ESG in your job title. You have ESG in the name of a fund. When I look at you, the question I'm asking is this person a feckless knave or a useful idiot? Because there is no middle ground here. So if you are an ESG person, rethink your life. Rethink your life. Because nothing you're doing. But the problem is, people want to have their cake and eat it too. They want to be good and be wealthy. The way I describe it is 40 years ago or 50 years ago, if you wanted to be good and you grew up in the US, you know what you did, right? You joined the Peace Corps. You went and worked in a poor country. You felt good, but how much did you make as a Peace Corps volunteer? Like $20,000 minimum wages. You know what I see 25 and 30-year-olds wanting today? They want to work in the Peace Corps, but be paid like bankers. That's basically it. They say, I want to work in the Peace Corps, but I'd like to be paid $300,000 a year. Welcome to reality. Goodness means giving up things. It doesn't mean acquiring things. And if anybody tells you differently, as I said, you're being delusional if you fall for that pitch, because it just doesn't hold. So I'm going to stop there. We have only about 5 or 10 minutes because, as I said, no. So are there any questions? All right. Ergun?
Thank you, Professor. It's always a pleasure to having your lectures. And by this opportunity, I'd like to thank also the Kadir University and the professors on the other side of the table. And more than a question, I'd like to highlight 2 points. Although I appreciate all of your books, narrative and numbers books perfectly fits in this lecture. I can say that because there are always narratives. Whether we believe the ECG or not, as investors, personally, what I think, we have to see where is it. As you perfectly stated, does ECG make the company better? And if it is, show me.
Right.
And for that part, I'd like to also highlight for other participants, you have a article, as far as I remember, 2020, valuing ECG, sounding good or...
Doing good.
Doing good, yes, that one. For technicalities, everybody can see that. And I thank you for this lecture.
Thank you.
Yeah. Any other questions?
Looks like I've shocked them into silence. So.
Oh, no. One possibility is that, Aswath, since some of the majority of the listeners, audience are non-native speakers, they may have some difficulty in following, and possibly you forgot to bring up your presentation because there weren't any presentation slides. But I shared the link that you sent me. With everyone, and there are statistics in that presentation that supports many of the things Aswath said. For example, there are a number of different ESG scoring companies, and if you look at the scores that they give to the same company, there is no agreement between them, and it's seen from several of the slides that you have in that presentation.
It's not only that they don't agree, they don't actually agree over time. So they take the same company in February 2021, they give you a score, and April 2021, they take the same company and give a score, they get a different score. You say, what happened? Well, Russia invaded Ukraine. ExxonMobil went from being a bad company to a good company. This is not a great way of measuring goodness if it shifts every time there's a macro event.
That is correct. In other words, your definition of goodness keeps changing over time. I mean, well,
and it does for all of us, right? I mean, that's not a problem as long as it's personal. If you have a consensus measure of goodness, how the heck do you even come up with it?
That is correct. I mean, so definitely, personally, my definition of goodness also changes over time, and that's normal for the companies. Nature, right? But nevertheless, if we are going to use this information to invest in good, as you said,
then I'm saying it's noise. It's not information.
But that is correct.
Noise.
Furthermore, as you also said, it helps us to avoid responsibility. Well, those guys are saying that this is good. Therefore, if it's good according to those scores, let me invest in this.
Yeah.
And as you said, when it becomes a game, there is always a way to win it if you have the money, if you have deep pockets, right? I mean, you can always hire the right people to increase your ESG score. It's some, as they say, what do they call it in economics? And there's endogeneity in it or something like that, right? I mean,
it's not, exactly. It's not an exogenous, it's endogenous because you created a feedback loop, right? Once you measure something, you change behavior to reflect how you're measuring it. It might be terrible behavior, but it pushes up your score.
Yeah.
Emery had a question, so I'm going to allow Emery to ask the question because, go ahead, Emery.
Thank you, Professor, for your good presentation, and it is very. I got a very good understanding from your presentation. And actually, I had a master thesis on the ESG and responsible investing, ESG scores effect on the portfolio performance, and I found there was no relationship between the ESG scores and portfolio performance. But now the initial publications on the ESG was doing good. Nearly all the papers emphasized the importance of the doing good. But now it's turned to a marketing tool for the companies, as you mentioned. And I'm just wondering that could be there any international definition of being good? Can it change
think about
person from the person?
So think about it. I mean, do you want an international definition of goodness?
Actually, we had international problems like climate change.
But there is no consensus. We have problems, but do you have consensus? The problem is easy, right? What do you need consensus on? The solution. Name me one problem where there's consensus on a solution. We live in a world of divides, right? So we might all agree there's climate change, but I'll wager there's no consensus on a solution. None. And if I impose a solution on you, you should be pissed at me. I tell people be very careful about turning this over to services because today they might be going after a group that you don't like. And you're saying, this is good. But tomorrow, guess who the target's going to be? It's going to be something you do. And then you're going to say, oh my God, why did we give Sustainalytics this power? So I don't think there will ever be a consensus on goodness. I don't think there should ever be a consensus on goodness. Right?
Thank you.
It's the nature of humanity. We will disagree about what goodness is, and that's the way it should be. Alkin, last question. I have to run after this. I'm sorry.
Dear Professor, thank you for the presentation and thank you for the recordings on YouTube. Those are very lovely resources. I am curious if you reject the ESG practices and consultancy sector on the basis of the principle that nothing except bottom line profitability
it's got nothing to do with this. It's a fact that they tell you that you can be good and be more profitable. Stop lying.
So it is the sales pitch and the profit incentives within the...
You think too many of these companies, do you think these consulting firms will have any business if they told the truth?
No.
That's really the question. So the reason they're lying is because they want you to use this, and that's just deceptive practices. That's just absurd.
A quick
so if they told
question.
the truth, do you think anybody would hire McKinsey if they said, hey, you could bring us in, we'll make you a good company, but it'll cost you 10% of your profits? Do you think a single company would? In fact, in most companies, you cannot do that because that's a violation of your fiduciary responsibility. So ESG has locked itself into a corner because a fund manager who uses ESG now and tells the truth is already violating its fiduciary responsibility. So if you want to create an ESG fund, you almost have to make it a niche fund where you say, look, I'm going to invest in goodness. It's going to cost you this much. But if you truly care about this particular practice of humanity, invest in our funds, but do it with open eyes. Where you're going to get 50 basis points less, but you're going to go to heaven. Does this sound familiar to you? This is how religion has been marketed for thousands of years. ESG people need to talk to the Catholic Church, to Islamic scholars. They've been thinking about virtue for hundreds of years. You guys show up in 2008, you act like you invented virtue. Talk to them. And every religion, what's the essence of goodness? You got to give up something, right? Lent, you give up. I'm sure as a Muslim, when you're told to do good things, you're also said this is the penance you have to do to kind of make sure that the goodness sticks. They're telling the truth. I have a lot more respect for religious finance than I do for ESG finance.
Thank you.
Yeah, it's more like a religion in a sense. Yeah, I agree with that.
I have to end, folks, because I have to run, as I said, to another session in about 5 minutes. So, no, I really appreciate this. And if you have any questions, you know how to find me.
Okay. In this case, we thank you, Aswath, for this wonderful presentation. And hopefully we will catch you again in the future in other webinars.